Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. I'm here for our once every 3 weeks Investors Observer Members Only Workshop. Welcome. Yeah, we got pretty much our standard slate of things this week. If you have questions at any point, go ahead and throw them in the question box, and I will either get to them as we go if it's relevant, or save them to the end. We'll talk a couple minutes about what's going on in Investors Observer, and then have a quick market update, and then the rest is member-driven content. Thank you to everybody who already submitted questions. That, always great to help get those slides in there so I can have a few more coherent thoughts as opposed to just taking all the questions off the cuff. And yeah, at any point you can submit questions ahead of time for the workshop. Just mention the workshop, or when you get that invitation, you can just reply to that and say, hey, here's my question. All right, so with that, let's go. Well, let's see what's going. Yeah, not a ton going on at Investors Observer to announce right now. We were very sort of busy behind the scenes. We have some big things we hope to roll out later in the summer, and we're doing a lot of smaller improvements that should hopefully make the website faster and more reliable, and a few things like that. But they are not very exciting, and I probably couldn't explain them if I wanted to. So, all right, on to the things I can explain. All right, so we went back, I pulled out to 2 years this time around, just because we're at the 1-year anniversary of the pandemic sell-off. And so, yeah, we're way back, well above where we were before that started. Almost back on trend, really, if you look at it. There may be a little bit of a gap there, but not a ton. So from that level, I think things are looking pretty good. And then our comparison. So the S&P 500 versus the equal weight. So equal weight has really been sort of outperforming the full index since, this is about early November. This is really when the good vaccine news started to roll in. Not necessarily a lot of shots getting in arms, but when it started to, when the vaccines came out that they were going to work, kind of a thing. And so the bigger names at the top of the index have underperformed a little bit, and the smaller ones have outperformed a little bit since then. All right, so S&P 500 versus the Russell 2000. Again, right, sort of a same story, same launching point, but small caps have really done well. There's been some volatility, as happens with small caps, but doing pretty well, all things considered, in that regard. Tech versus industrials. Yeah, industrials outperforming again recently. This is, and we'll talk about it later on some of the other slides I have set up, but we talked, I feel like, for most of 2020 about story stocks, as opposed to sort of real economy and reopening stocks. And this is, right, this is, companies that make things and move things around coming back as the, techs have, lagged a little bit. All right, again, financials, same basic thing, right? Like, financials do well when the economy is doing well, right? I mean, right, you're basically taking a piece of every transaction. If there aren't a ton of transactions, you're not doing so well. If people start spending more, there's more transactions to take a piece of. There you go. All right, so this one is right. So I don't know how many of you are familiar with ARK. They're a big investment firm run by Cathie Wood. She was on TV a lot in this period. I think she's been on a little bit less more recently. In any case, this is an ETF that owns Tesla and a bunch of sort of the super hot tech names, some biotechs. It's all the sort of tech stuff that's been super popular lately. Okay, and she is, over the last year, absolutely killing the S&P 500 and has, more than doubled. It's at points she was, up more than 250%. It's fallen off a little bit recently. I think Tesla's fallen off, things like that, etc. But I'm going to refer back to this slide later, but I just wanted to put it in with the row slides. But yeah, she's doing really well, okay? This is obviously not great, but at the end of the day, you're still at up 170% over the last year. All right, and the other thing people have been talking a lot about recently is the rise in 10-year yields. So this is 10 years worth of the history of the 10-year yield. Okay, so yeah, it's gone up a lot, but it's gone all the way up to about where it was pre-crisis, which is not super far away from where it was in, for a time in 2013 or a time in 2016, 2017. It never actually got this low during the 2008 recession and financial crisis. So the idea that yields are high is, like with a lot of things, it helps to zoom out your chart to get some perspective. And nobody was worried about inflation in February of 2020. So I don't really see this as being a problem. I see this as essentially bond investors saying, hey, we're getting back to a normal economy soon. Interest rates should start to get back to normal economy interest rates as opposed to panic level interest rates. I don't really think it's a problem. All right, so this is another chart that we've been talking about here recently. So this is the advanced decline ratio for the S&P 500. So it's basically the number of stocks that are advancing less the number of stocks that are subtracting or that are falling. So the most astute ones you have probably already noticed, there's 504 here and 503 here, which for an index of 500 stocks to have more than 500 as a high and a low. That's because there are a couple, like Google has two classes of shares, so GOOG and GOOGL are both in the S&P 500. So there's actually, I think it's 506 stocks in the S&P 500. It's 500 companies. All right, so essentially what's happening here is, the highs are days where basically every stock is up, or, if it's one leg of the candle, every stock was up either at the beginning or the end of the day. And the lows are every stock is down at the beginning or the end of the day. And the 0 point here, this line is where it was when I took the screenshot. The 0 point is essentially, 250 or so stocks are up and 250 stocks are down. All right, so back, every day was everybody up, everybody down. Back in, I didn't really get the crash, but even into April, we had some of these days where everybody was down or everybody was up. And then we had a bunch of days with, look at these swings. We went from everybody down to everybody up some of these days. But what interests me the most is this bit in here from sort of the end of February on, where we have some, there's some swings here, there's some long wicks on some of these candles, etc. But it's much less just painting the whole board up and down every day. This is more of what a normal stock market looks like. And what this means is that for short-term traders, this day is real easy. Okay, everything's going up. Honestly, these days are pretty easy. Everything's going down. You can be in or out on those days, but if you're a short-term trader, picking where to put your money is not hard on a day where everything goes up or everything goes down, It just doesn't matter. Where it gets harder is, these days where some things are up and some things are down. And it's not necessarily the same thing from day to day. There are probably some trends, as you could probably figure out from some of those charts we were just looking at. But yeah, these are more these are more normal market days where some things are up and some things are down, but overall the advanced decline isn't at one extreme or the other. And this is really just sort of, I mean, like this chart, right? To me, what this says is things are getting back to normal in markets. All right, so what else is happening? The economy in the US is less virusy than it's been for a while. Cases are stable-ish. They've falling in some places, rising in others. Vaccine production and distribution is ramping up. Warmer weather is either here or on the way, depending on how far north you live, which of course means that there's more outdoor dining and other things that people can go and do. So there'll be some additional spending because of that. Other parts of the world are sort of a different story. France just announced today, I think they're going to lock down for like 3 or 4 weeks nationwide. Obviously, places like Brazil still have a ton of virus cases. And so what I think this means is the US could sort of outperform the rest of the world for a while in terms of, right? So if you're worried about inflation, one of the things you tend to look at is commodities. But commodities markets tend to be global, right? Like oil is oil. They pull it out of the ground and sell it to whoever wants to buy it. It doesn't really matter where there are. There are some, there's a WTI versus Brent spread. So there's a little bit of a difference between onshore and offshore oil, but it's not huge. So what this means is that if the US economy comes back and really booms, Europe is going to be behind us in that regard and probably not sucking up as many of those commodities and other resources as they would be if we were recovering at the same rate, which probably means commodity prices don't go as high, which, you can discuss whether or not short-term changes in commodity prices are actually inflation, but in any case, I think that's probably good for users of commodities. For the most part anyway. And yeah, I think more stimulus is going to be at least negotiated. I think Biden's supposed to announce an infrastructure plan today. That could help, push the economy into another gear, maybe even spur some new opportunities depending on how the money is spent, right? I mean, electric car stocks are super hot, but there aren't a lot of electric cars being sold. You provide some tax credits for not just purchasing of automobiles, but also some of that infrastructure. One of the big things that keeps people from buying an electric car is what's known as range anxiety. Well, if you know there's going to be 6 places between here and where you're going where you can recharge your car, you'd be a lot less nervous about having an electric car, right? Like, with the exception of very few places in the United States, people aren't worried about like, oh man, if trying to go from here to there and figure out where I'm going to stop for gas is tricky, right? Like, it's not even a thing you think about. Whereas with an electric car, it is a thing that at this stage you kind of have to plan out if you're going further than the range of that car. So some spending and incentives in those regards could help some sort of nascent industries. And then, yeah, inflation. I think some price volatility is likely. Supply shortages, even without, ships blocking the Suez Canal for the better part of a week. There's still a lot of supply shortages. I think people are familiar with the idea of the chip shortage. But there's just other things where, factories were shut down, people were making this, and now they need to go back to making that. That kind of thing is likely. And so there will be some price volatility. There may also be some, just waiting for things, right? I feel like I talked about this last time or maybe the workshop before that, but there's just a wait for bicycles right now, which is not exactly the same as rising prices, right? Like, the bike shop could get rid of their waiting list by just tripling the price of bikes, but they'd rather sell those bikes to people who are willing to wait, so they don't raise the prices. But yeah, bond yields are back at pre-COVID levels like we just looked at. And generally, I think that shows confidence in the economy more than other things. So I'm not really worried about inflation. I do think we're going to see some what I'll call price volatility in certain places here and there, but I don't think it's a case of too much money chasing too few resources, which is really what inflation actually is. All right, so some other charts. Yeah, it turns out we're more than a year since everyone started putting these charts together, so the year-over-year comparisons start to get a little weird, right? Like almost 70% up spending from a year ago, but yeah, a year ago was here, so that's why. So the change from the pre-COVID trend is this other colored line, and we're still down a little bit from that, but we bumped zero for the first time in a year earlier this week. So things are starting to come back, and again, like warmer weather, a new round of stimulus checks hitting, that's really going to help here. And then from the TSA, again, the charts get complicated when you're trying to track several different things. So this green line is the 7-day moving average of passengers in 2019. This line with the big swoop is 2020. And then this is every day so far in 2021 and the moving average. So we're higher than we were at any point post-crisis in terms of air travelers. And we don't seem to be seeing a huge surge in coronavirus cases, which is positive. When things got to their highs around Thanksgiving and then Christmas and New Year's last year, that came with just a massive surge in coronavirus cases. To see this go up and not see a big surge in virus cases is encouraging. All right, so on to the questions. So Jose said, are we in a temporary downturn or is it likely to continue? And what is your take on how to play this current volatility? So, yeah, I said I was going to refer back to some of those charts earlier. Are we in a downturn? We hit a new high on the S&P 500 earlier today. If we go back here, yeah, I mean, show me the downturn on this chart, right? Like it's just not there. And then, yeah, the Russell 2000 is off its highs, but it's still up a lot for the year. So I don't know what's in Jose's portfolio. My guess, based on the second part of his question, which we'll get to in a minute, is he has some of these stocks, right? Some of these things that went way up and have come way down. And I don't know when they were purchased. He may still be up. He may not be up. But yeah, to say we're in a downturn seems not really correct. Right, we're 2 weeks away from a high on the Russell 2000. The NASDAQ hit a high in February, which was, well, I can still say it for today, just last month. So yeah, I don't think we're in a downturn. I don't think there's any real question about that. But yeah, so these are two bullets that I actually had in the presentation from 3 weeks ago, right? So story stocks were a big theme in 2020. Economic prospects weren't great, so people focused on exciting new industries that offer the opportunity to grow without economic growth. Electric vehicles, pot stocks, SPACs, other technology, right, including biotechnology. Now that economic growth is back in the picture, other parts of the market become more attractive. Okay, I mean, yeah, restaurant stocks just aren't exciting in 2020, right? And not just restaurant stocks, but restaurant supply stocks, even things like Coca-Cola, right? Like I don't know about all of you, but I'm much more likely to drink a soda away from my house than I am at my house. So this period where I've been at my house for a year, not consuming food and beverages away from my house very much, haven't had a lot of Cokes in the past year. Probably going to have a lot more Cokes in 2021 than I had in 2020. That kind of thing, right? There's a growth story there now. Whereas when everybody's, staying home and limiting their activity until question mark, right? Now the story stocks become attractive. But once that question mark goes away, we know when things are going to reopen, or at least that they're going to reopen, which is what we were looking at that chart earlier, right? That things started to take off in November. Nobody had been vaccinated at that point. It was really just an issue of, hey, the vaccine works. This is going to go away. And then, we started to see this rotation. So yeah, there are a lot of stocks that are down. A lot of them are, right, in this group: electric vehicles, pot stocks, SPACs, other technology. these things were always speculative, and depending on when you bought them, they're still way up from a year ago. But yeah, I mean, you probably should take those stocks on an individual basis. I think Tesla, I talked quite a bit last time about the valuation of Tesla, which I think is a little high. But I think the growth prospects for Tesla are different than the growth prospects of a Zoom, right? Like, there is room for an electric car company on the scale of GE or Ford in the future, right? I don't know who's using Zoom in 6 months that isn't using it today, right? Those are different growth stories. And yeah, the real way to play this volatility is to have a diverse portfolio, right? If I was looking right now and I had a portfolio full of tech stocks, I'm going to go look for things that will benefit from a growing and reopening economy, right? I mean, things you can, things you can touch is one way to think about it, right? Or things along those lines, right? Those are the things that will benefit from a growing reopening economy. Places you can go, things you can do. That's the kind of thing that I think is going to go, sort of be the leader now. All right. So Jose had a couple more questions about considering the volatility of biotech stocks, especially at the announcement of trial results. Does IO provide any predictive help in that area? I'll just run through all the questions, then we'll get through the answers. The IO stock ratings take into account the probability of success for existing trials conducted by the biotech stock. Are there any tips for successfully trading biotech stocks, especially for a trader selling cash secured puts or covered calls? All right, so he's got 3 questions. I managed to come up with 4 points to respond somehow. But yeah, that's just how we do it apparently. All right, so the timing of these announcements in terms of biotech stocks can be hard all by itself, right? They're looking for certain endpoints. A lot of cases, it's not like, oh, this is a 6-month trial. Like, if it's a 6-month trial, it's easy to know when the trial ends, right? But they're looking for, okay, we had this many people in the placebo group get sick, and so now we know, some broad ideas about the exposure of the population, some other markers in the study, and so it can take a varying amount of time. And even then, the company may take a while after the points are met to release data. So it's very hard to know even when those announcements are coming, much less what the actual results will be. Right? Thus the volatility. If either everybody knew when it was going to happen, it would be a thing like earnings where you see spikes of volatility, right, where everybody knows it's going to happen, but the outcome is uncertain. Or if everybody knew what the results were and the timing was uncertain, there would be no volatility because everybody knows the results, right? So that stuff is really hard to predict, and that's why there's volatility around it. Also really hard to predict is the probability of trial success. My guess is companies wouldn't start a trial if they didn't expect some positive result. And so there's probably some where there's more likelihood than others, especially if it's a drug that's been approved to treat something, and then you're trying it to treat a similar thing. That seems more likely than a thing that's never been tested before in anything. But again, really, really hard to predict, right? That's why they do the trials. And so yeah, we certainly don't provide any predictive help because predicting things is hard, and it's just not something that's possible as far as I'm concerned. And then the probability of trial success is also hard to predict. And so the ratings don't take into account any probability of success because I don't feel like that's knowable. So tips for successfully trading biotech stocks, especially selling cash secured puts or covered calls. So the thing I'll say here is position size is a very important part of risk management. Okay, so if you have something that is highly speculative, and we'll talk about this a little bit more, I think the next set of questions is also about biotech stocks. right, something that's highly speculative, you have a chance for a huge payoff, but also a huge loss. And so you don't necessarily want to put a ton of money into that kind of a thing. And so I have some questions about cash secured puts or covered calls, right? So right, the premiums are high, okay, which is attractive for option sellers. I get that, but they're high because of that volatility. And so what you're looking at here is relatively small and fixed gains, right? Once you sell that put, you know exactly what the maximum you're going to make from that trade is. However, right, the stock could go to zero, at which point you're going to lose an amount of money that is significantly larger than whatever you sold that put for. Even if the stock doesn't go to zero, it can go down a lot, and you can take a big loss, and your gain wasn't necessarily, right, you can take a loss that is not really proportionate to your gain. Okay, and the same is true with covered calls, right? You know what the maximum profit is up front, but you can take a really big loss there. And so for something like this that's very volatile, I understand the attraction in terms of wanting to sell the option because it's a big juicy premium because of the volatility. But the risk reward there doesn't necessarily really make a ton of sense for me. So probably what you want to do is think about something where you have where the like dollars at risk and the dollars to be gained are closer together. Something like a vertical spread or even a directional strategy, right? You know, spend $5 to buy an out of the money call. You lose $5 if the trial goes badly, but that could double or triple if the trial goes well. As opposed to, you know, on the covered call side, you might get $5 if your covered call goes well, but you might lose double or triple that. You know, if the trial goes badly. So I think maybe those are the ways that I would sort of try to handle that is by thinking about it in that way. All right, so Luca asked, what will be the best performing biotechs for 2020, and will biotech continue to be a top industry for 2021? So yeah, a lot of this sort of just refers to the previous slide. The nature of the industry makes which stock will be the best performing essentially impossible to answer. But the thing is, investing isn't about predicting the future, right? I mean, yeah, if I could reliably predict the future, I probably wouldn't be here talking to you, right? I'd be betting on horses or something else, or yeah, there's any number of things I could be doing if I could reliably predict the future. Investing is really about being properly positioned for a wide range of potential outcomes. Okay, right? Lots of things can happen. And then you want to maybe be a little overweight the things that you think are more likely to happen than the others. But yeah, I mean, you wouldn't put all your money in lottery tickets, right? And even if you did, you wouldn't put all your money in lottery tickets with the exact same number. That would be crazy. And so what you want to do is spread things around, right? Put a little here, put a little there. Diversification is the name of the game, right? And so one of the reasons biotech can be such a high-performing industry is, again, back to risk reward. Okay, so risk reward and math are really sort of what makes that possible for the group. Okay, an individual company can do really well or do really poorly, and that's hard to predict. But I mean, if you think about it, right, a stock, especially something in biotech, you know, you can see those stocks double or triple or go up, you know, 400, 500%. That happens. It turns out they can only go down 100%. So you get a couple stocks that go up 400% and a couple that go down 100%. You're still way up. And so if you're looking at an index or some other group of stocks, you have some of that working in your favor. You know, there's some single stock investors in biotechs who took massive losses, and there's some who had massive gains, depending on which single stocks they picked. But for the group, you know, the group looks great, or it's like, oh, hey, biotech is just printing money. Well, really depends on where you are in biotech. And so, yeah, that makes the industry attractive, but makes trying to pick the best stock dangerous. So the name of the game there is, you know, buy the group, right? There's a couple of ETFs that just hold all the biotech stocks. Or, you know, spread it around with some strategy where you can put relatively small amounts at the in the places you think are most promising. All right, so these questions came from Robert. He said, what are my general thoughts on Nokia, Ericsson with 5G? Seeing some good news. So yeah, I mean, so the thing with 5G is it's the next generation of wireless technology. Okay, I heard a lot of the same things in terms of, oh, these are the stocks you need to buy to get super rich about 3G and 4G. And yeah, it turns out that a lot of those small stocks that people I didn't know were sending me emails about didn't do anything. This is essentially an infrastructure problem, right? Like there are a few relatively large companies that make the sort of things, right, that power a wireless telephone network. And yes, Nokia and Ericsson are absolutely two of them. And there is some room for growth there, but yeah, I feel like the promise of 5G has been overstated by the people selling or pitching all those small cap stocks that promise to make huge returns. It's an incremental technology increase as far as I'm concerned. I think those stocks are fine. I don't really have anything bad to say about them, but I also don't know that yeah. I don't think this is the invention of this 5G is the invention of the steam engine or anything like that. I think it's the next step forward in wireless technology. And I'll give it about 3 years before you start getting emails about 6G. Right? It's just what happens. All right. So with Solo putting a factory in Mesa, Arizona, would it be a good option in the EV space? So yeah, Solo has barely sold any vehicles. They just announced the import of some display and demo units, I think earlier this week. And those were, yeah, calling it it's definitely a vehicle. Calling it a car seems generous. It's a very small little pod with wheels, let's call it. It's kind of cool. I can see a use case for it. It's yeah, certainly not a car you're going to put the family in and take them anywhere. So yeah, I mean, a U.S. funding might help. U.S. factory might help the company get some funding or tax credits or something like that. But yeah, I looked at analyst estimates, and yeah, going out 2 years, Solo isn't expected to make any money. They're not supposed to be expected to be profitable. I don't know how long it's going to take to build this factory. But yeah, a factory that it's really hard to come up with some analysis of how a factory that hasn't been built helps a company that isn't expected to be profitable for years. Possibly it helps in terms of those tax credits and other things that I just talked about, but I really don't know. I mean, it's nice to see people making things in the U.S. I'm all for that. If you liked Solo because of that, and as part of your broad investment in the EV space, you wanted to put a little money there, I certainly couldn't blame you for that. But in terms of now that Solo's coming to Arizona, do we want to go all in on them over somebody else? I don't think so. All right, so general thoughts on some of the American lithium ion players versus the Chinese component. So it's a little hard to know exactly what's being asked here because there's a bunch of sort of steps in the lithium chain, right? There's mining lithium, there's refining lithium, and there's actually making batteries. So there's actually a company called American Lithium, which seems like it has some valuable assets, but also I was looking at their financial statements yesterday. It has not, to this date, actually sold any lithium. So it seems to own some land where there does seem to be some lithium. It has not yet sold any lithium. Albemarle is another company, the ticker is ALB, that is in a similar business. It has actual running operations. It's possible both could work out. American Lithium may be the next Standard Oil. I don't know. But Albemarle seems like probably a better bet. It may be a smaller, smaller return there, but it seems a little bit less risky. And then on the battery side, and yeah, so on the battery side, Panasonic seems to be the biggest battery maker. But batteries are basically a commodity, right? I mean, a double A is a double A. I don't know that there's a whole lot of specialty batteries being made. In fact, I kind of hope there aren't a lot of specialty batteries being made, because it really hurts the economics of things going forward, right? I mean, you could potentially get into a Betamax versus VHS situation where, oh, I bought this electric car and I need some batteries, and oh, they don't make those batteries anymore, kind of a thing. So now you got to get a whole new car because the batteries wore out or the batteries were bad, something like that. So I kind of hope that batteries are being standardized and are much more of a commodity, which, I mean, to be honest, lithium itself is kind of a commodity, right? Like, they dig it up out of the ground, and once they refine it, it's lithium. It doesn't really matter where it comes from. I don't think there's, obviously there's probably some lithium deposits that are more profitable than others because of purity when it comes out of the ground and how much processing it takes. But once you get it out of the ground and turn it into lithium, it's all just lithium. I don't think it matters. All right, Tom said, what is your position on Bitcoin? So yeah, first off, full disclosure, I've been pretty ambivalent about it since I first heard about it in 2010 or so. I think it's an interesting piece of software. But other than that, I don't have I don't own any. I haven't had a lot of reason to. I've seen several boom bust cycles. Bitcoin is absolutely higher than it has been at almost any point, except for maybe last week. I don't know exactly where it is today, but it's relatively near an all-time high. But yeah, I mean, as those of you who remember 2017, there were a ton of blockchain investments. All kinds of companies were like, "Oh, we're going to get on the blockchain. We're going to do this on the blockchain." And a lot of those sort of investments have just turned out incredibly poorly or gone away. The price of Bitcoin does keep going up. There's a couple of other cryptocurrencies that haven't totally fallen away. But yeah, a lot of the stuff from 2017, which was the last time you just heard about this stuff everywhere you went, has just kind of gone away. Yeah, so the thing is, the price for Bitcoin keeps going up, but I don't know very many places you can spend it. Tesla will take Bitcoins in exchange for a car, but that car is priced in dollars, right? It's not like the price of a Tesla is one Bitcoin. The price of the car is some number of dollars, and you can show up and they'll do the currency conversion for you. PayPal has some other services offering Bitcoin payment, but PayPal announced this thing earlier this week, and yeah, they're going to pay the merchants out in dollars most of the time. So what happens is you have some Bitcoins, you say, "Hey, I want to buy something," and PayPal says, "Great, we'll convert your Bitcoins into dollars and give the merchant dollars." And so really, I mean, until I know where I can buy things with Bitcoin, I don't think it's money. Right? Certainly not, some replacement for money. It might be, it may be a good investment, right? The price of it keeps going up. At a certain point, it's hard for me to say, like, no one should ever buy this. But also, I don't understand what the point of it is. Because again, right, like, it's not money, okay? If I have euros, I know where I can go to spend euros. I mean, I have to cross the ocean, but I know I can go across the ocean, and there's millions of people who want my euros. If I have Bitcoin, I know I can sell it to some people on the internet, but I don't know where I can buy anything with it, right? It's not money as far as I'm concerned. It's something else. And so yeah, just to throw it in here, the non-fungible token or NFT thing, I'm even more skeptical of. One of the things about digital anything is a copy is the same as the original. So having some claim to the original, I mean, if you own an original painting, it's original, right? A copy is going to be a copy. It will be different. But owning an original image, the copy is exactly the same. It doesn't matter. And these NFTs, they're not a licensing right. Right. In a lot of cases, the originator of the artwork or whatever still retains the right to, prints or distribution or any of those things that you might think you're buying. So you're really, yeah, you're just buying a particular file that tons of other people can have the exact same thing of. All you have is some digital token that says this is a particular version of this. It seems like Beanie Babies to me, right? The prices are crazy. People are going nuts for them. But yeah, I mean, at least when people are done with Beanie Babies, it had something their kids could play with. I don't really understand the point of the NFTs at all. Again, I've been wrong about the price of Bitcoin. I still don't get the point of it. It may be a good investment. I might be wrong about NFTs, but it's very confusing as to what's going on or why anybody sees any value with that. All right, so back to stocks. What do you think of balancing down a stock you bought at 18 and then it drops to 8, or selling it with a loss and then buying it again at 8? So yeah, I mean, yeah. If you bought the stock at 18 and watched it go all the way to 8 and now you want to buy more of it, it seems like you really like the stock. So yeah, selling the stock at 8 and then buying it again at 8 seems pointless. And if you're thinking that like, oh, I can sell it at 8 and take the tax loss and then buy it again, you can't do that. There's something called the wash rule that keeps you from doing that. So averaging down can be a decent strategy for long-term investors. But yeah, you're talking about a stock that lost more than half its value. I don't know exactly what the stock is, but with a stock that volatile, I honestly think I might find something else. I'm not saying sell it all at 8, but that seems like a lot of money to put into something that just lost more than half its value. All right, so second question. Sometimes we see an analyst rates a stock, for example, VIRX, with a price that is so high for the moving of the stock itself. Do these people use different ways to cheat investors? All right, so let's go look at this real quick. So yeah, I assume this is what he's talking about. Okay, they put a $45 price target on a stock that's at, we'll call it $9. Okay, so Evercore has been around for a long time. They make a lot of money from investment banking. It seems, yeah. I feel like if you were going to go the route of trying to manipulate the stock market for gain, this particular stock and this particular price target seems weird to me, right? I mean, why 45? Why not? I mean, 20 is more reasonable, right? Like if you're trying to manipulate the stock, call it 20 and it doubles and you can do it again. You're way more, it seems, right? If it's fraud, you're way more likely to get caught saying it's going to go up 4 times than saying it's going to go up 2 times. I don't think it's fraud. I don't think they're putting a high target on it to try to manipulate the stock. I haven't seen the research. But, you know, like we talked about earlier, biotech stocks can go up 400 and 500%. It happens. You know, I'd be interested to see the research note and kind of read the case, but yeah, I don't think there's any manipulation or attempt to cheat investors going on here. My guess is the, you know, analysts or analysts have some case there. There's, in most cases, there's a note behind the headline that gets into why they, you know, how they come to that price target. The price target isn't arrived at in a vacuum. There is, in most cases, a reason that that price target is there. All right, so I think this question came from Garth. He hits the next slide also. So he says, I can't figure out why Walmart is in such market disfavor. It has declined while other major online retailers are blazing ahead. So yeah, first of all, let's get back to whether or not things are up or down. So we'll pull up Walmart, look at the last year. It's up over the last year. I mean, it's up $20 on a, what do we call that? We'll call that 19%, okay? Costco is, go to a year, make it a percent. Costco's up 22%. Now the charts look a little different, right? Like where the gains came are a little bit different, but I'm going to call that pretty close to the same performance. Amazon, I think, is up. That's not the figure for Amazon. Considerably more than that. Yeah, Amazon's up 58%. All right, so, all right. So Walmart and Costco even have, I went back here too soon. Similar PE ratios. So Walmart, we've got a PE of 28. Costco, we're at 30. I mean, those are pretty close, right? Like in terms of comparing two stocks in two industries, or in the same industry, that's super close, really. So yeah, I mean, obviously the gains have come at different times. Some of that might be the difference in clientele. I don't know. Amazon is really just a different animal. But yeah, I mean, the thing about Walmart is I think Walmart has a particular reputation and customer, or at least has a reputation for having a particular customer. It's a store for necessities that tends to have a less affluent customer. Right, a lot of those people are service workers. Service workers hit hard in the pandemic. The Walmart customer is probably slower to recover from the pandemic than the Costco customer. Again, right, like the perceived Walmart customer versus the perceived Costco customer. Costco tends to have a little bit more affluent consumer, right? I mean, think about Walmart. There are not a ton of things in a given Walmart that are just off the table for people at the Walmart, right? There aren't very many things in a Walmart that the average Walmart shopper is like, well, I'll never be able to afford that. Costco, on the other hand, there are things that would be aspirational or big purchases, right? Things you'd save for years to splurge on, right? Jewelry, cruises, 70-pound wheels of cheese, right? Those are big splurges for a lot of people, but there are a lot of people who can just buy that, right? Shopping at the Costco. So they're different in that regard. And so I think, as things recover, I think Walmart may see some lift off a little bit slower than Costco, just for those reasons. Whereas, yeah, I mean, Amazon is the everything store. It sort of covers both of the above two categories. My guess is it probably misses some of the consumers at the very low end, who aren't probably Costco shoppers anyway. I mean, if you think about it, if you're really trying to stretch and make ends meet, paying a couple $100s for the right to shop in a store that doesn't give you anything is tough to justify, right? I get that. And so, yeah, I think Amazon probably misses a few of those people too. It's, started accepting food stamps and some other things to sort of try to capture the entire range of consumers. But Amazon also makes a ton of money from things that isn't selling stuff, right? The AWS business is massive. You could break Amazon into 2 or 3 different business units, and probably all 3 of them would be S&P 500 or even S&P 100 companies. Amazon is just massive and it has too many things. It's not a good comparison in terms of any other retail outlet as far as I'm concerned because of that. But yeah, I mean, certainly Walmart the stock has done a little bit worse recently than Costco, but I don't know, you could say Walmart ran up too early on the recovery and Costco has come back later. But yeah, they seem pretty similar from looking at them the way we just did. All right, and then this was the rest of Garth's questions. The best key call options. How are option month and strike determined in IO's trade suggestions? So first of all, for those of you that don't know what we're talking about here, so all of the trades in our option screener have what we call a key rating. So the key rating is as you can read from hovering it over, our proprietary risk ranking system that runs from 1 to 5. 5 is the lowest relative risk, 1 is the highest relative risk, and these are by strategy, okay? So don't compare a covered call to a vertical spread and think, oh, these have the same risk because they're 5 keys. That's not how it works. It's by strategy. So first of all, that's what the question is about here. So how are the month and strike determined? They're determined by algorithm. We do not put in the month and strike for thousands of trades in the option screener every day. Now the algorithm was developed by our analysts, right? You get years of experience picking option trades by hand, structuring them by hand. You figure out like, oh, hey, the computer could do this math way better than me. Or if not better, at least faster. So yeah, they're, in a lot of cases, the sort of the trade an analyst would pick, it's just, you can get, 3,000 covered calls, about the same number of short puts, right? Like, we have a relatively small analyst team here. It would take us days to come up with 3,000 covered calls, to actually pick the month and strike. So the computer does that. So seemingly all the trade suggestions are in the money when initiated. Obviously at the money is where you get the most premium, and that is the idea here is selling option premium. But yeah, right, like stocks close at all kinds of crazy prices where there isn't an option strike, so you can't pick that one. And we do move the strike price around for stocks that we have a higher, stock score on. We will let the strike price be further out of the money. Whereas for once we have a lower score, we actually push it down further in the money for essentially safety reasons. Probably I would guess the average one is probably a little bit in the money, but the real goal there is to sort of on mean have them be at the money. The exercise is the point for the covered calls, right? The expectation is to have the calls assigned because we're maximizing the premium sold. And the reason for that is, right, like as we've talked about some number of times during this presentation, predicting the future is really hard, right? Like knowing what stock prices will be in the future is tough. I'm relatively certain tomorrow we'll get here. And so selling time value works, right? Like time value runs off at a rate of roughly 1 day worth of time value per day elapsed. Okay. To be honest, I guess if tomorrow doesn't come, I probably won't worry about my calls too much. So what we're trying to do there is maximize the time value that we're selling because that's the thing we can control and feel like we can predict much better than trying to predict prices of stocks. We feel like we can have some good ideas about what prices of stocks might be, what kinds of stocks might go up or down in certain times, but trying to predict the actual prices is tough. And we do have the out of the money tool available on the single stock pages. So if you go to Agilent here, we have the out of the money calculator. And so you can even put in a cost base. So even if you bought the stock years ago, you can put in $80, say you're making a trade for income generation, and it will give you a call that is out of the money. Usually it's going to have a probability of assignment of less than 30%. So if you want something that's much less likely to get assigned, that's the way to do that. All right, so that is the end of the pre-submitted questions. Thank you to everybody who sent those in. All right, let's see here. Update on the Tilray merger. I don't have any reason to think it's not coming. I will admit to not following it super closely. But yeah, I assume it's moving ahead. I don't have any reason to think it's not. I haven't seen any reason to think it's not. It's a weird merger where they're going to pay you in stock. So, you got to kind of watch the moving parts there, but I think it's fine. All right, so Pete has an interesting question here. What do you think about a $4 stock? Where would you be putting down? Would you be wary of a $4 stock? I mean, just at random, a $4 stock is kind of interesting. It's on the low end, obviously. Typically, things on the low end are riskier, right? Nothing IPOs at $4. So for the stock to get to $4, something bad probably happened to it. Like just at random, I would probably want a higher stock. One of the reasons for that is, right, the minimum listing requirements on both the NASDAQ and the New York Stock Exchange is $5. And so at $4, you're looking at something that's probably been beaten up and is maybe looking at being delisted, or might already be trading over the counter where there's less liquidity. Also, things like less stringent reporting requirements. So yeah, I mean, I can't tell you $4 stocks are worse than $40 stocks, or any particular $4 stock is worse than any particular $40 stock, but I would say the average $4 stock is probably going to be a riskier bet than the average $40 stock. Do I have an opinion on bank stocks for 2021? I mean, they definitely fall into that sort of reopening category. It's, how much of the move has been made, right? Markets tend to be forward-looking, right? How much of this, that's a giant recovery, right? I mean, we're back, at or above the trend from pre-crisis. So I generally like banks in a growing economy. Obviously, stock price here doesn't count the things like most banks pay dividends and things like that. But yeah, I mean, banks definitely fall into my reopening growing economy category that we talked about earlier. All right, so many SPACs have recently sold off, but do we think SPACs are bad from an investment perspective? I mean, I don't think they're great. I think if you look at the history of SPACs, I think the average SPAC hasn't done that well. I know there are a lot of IPOs that don't do well, but the reason companies go public through SPACs is typically that they don't want to go through the IPO process, which is either a reason of expediency, right? You can get public faster if you go through a SPAC, or possibly, they don't actually want to, the requirements are different, right? So if you're going public through an IPO, you can't announce some, future projections about what you think your earnings are going to be. There are very strict rules about what your current financial position has to be disclosed. Those don't exist with a SPAC. So it's a little bit, right? I mean, would you rather buy something where would you rather invest in something where the owners of the company are willing to be very upfront and tell you what the condition actually is, or where the rules about what they have to tell you are a little bit lighter and they can tell you about what they hope things are going to be in the future? That's one thing. The other thing is, okay, all the people buy the SPAC shares in the SPAC IPO at $10. Okay, the SPAC sponsor gets usually about 20% of the SPAC shares, and he doesn't put any money in. Okay, so already your $10 isn't buying you $10 of something because somebody else is getting a piece of it, right? And now that SPAC investor is going to take a fixed pool of money and go try to buy a part of a company. Well, all he's got is $10 a share. He's already taken a piece of that, so now your $10 is worth, maybe $8 because he took 20%. And now he's going to go buy, try to buy a company. Do you think he's going to get? Are the sellers of the company going to sell him, essentially less than or more than $10 worth of the company for your $10? It's yeah. I mean, it's a way to invest in very speculative things, but I just as soon wait till after the merger and evaluate the company based on what's actually happening there than try to get in on the SPAC, especially before the merger even happens. Like I said, at that point, you're just handing somebody $10 and saying, "Hey, go buy me $15 worth of lunch." I don't feel like that's a good deal. A good source for listing out companies that may be going under. I mean, yeah, that's about digging through earnings reports. It's hard to tell. I mean, you can look at leverage ratios and things like that, but yeah, those things are sort of hard to tell. All right, so I got a couple questions about the chip shortage. So there's sort of two different chip shortages. There's the like components and things like automobiles and things like that. And then there's also a shortage of like graphics chips, which are made by NVIDIA and a couple others. AMD is another one. So, I mean, you can look at NVIDIA, which is interesting. It's not at a high because they can't keep up, right? If you can't keep up with demand, at some point demand starts to dissipate. And AMD is, I believe, also off their high. So this might be a good time to get in. It's hard to tell. And then you can look at some other, AMAT makes fabs, which are the things that you use to make semiconductors. I looked at this a couple weeks ago, sort of for my own account, and it's tough, right? In terms of, is it going to be higher next week than it is today? I don't know. Do I think that the economic reliance on semiconductors is going away anytime soon? No. So, if you're buying it for a retirement portfolio, by all means, I think, some handful of chip stocks is probably a thing that everybody should have. If you're looking for something that's going to run up in the next 3 months, it's hard to look at charts like this and be like, oh yeah, this has got 3 months of run left in it. It might. I don't know though. It's hard to predict that sort of thing. Let me swing back through here. We're a little over time. All right, opinion on cannabis stocks. I mean, I think I feel a lot better about them than I did a year ago. They're also a lot higher than they were a year ago. And it really depends because, okay, so ACB is a cannabis stock. They cultivate and sell recreational and medical cannabis. Tilray is another one. Right, cultivates and sells. You got CGC. Cultivates and sells. But then you've also got a bunch of companies that make, let's call them cannabis related products. You got companies that buy cannabis and do things with it and sell it. To me, I think this cultivate and sell thing is hard for me just because, man, it's growing plants. Right? Like farmers get rich by selling the farm for the land most of the time, right? And that's essentially what this is about. Getting in a competition to see who can grow a plant the cheapest is typically not a way a ton of people get rich. So I think there's some interesting opportunities in cannabis. I absolutely think it's a growing industry, and these guys might take off. But yeah, I mean, if Philip Morris called up a handful of farmers tomorrow and said, "Hey, we're growing weed now," I think they could probably just bury some of these, newer, smaller cannabis companies that have, sort of sprung up recently in excess weed if they wanted to. I'm not familiar with the name. Yeah, so this is an ETF. I mean, this is the kind of thing that when I say spread the money around, this is an ETF. Okay, so it's a fund that invests in the cannabis space. So presumably they have, things spread around from growers to some of the other, some of the other things. There's some interesting pharmaceutical things happening with cannabis and things like this. If you want to have some exposure to cannabis and don't want to try to pick the right stocks, something like this, or I think MJ is another cannabis ETF. Yeah, those things are probably a good way to do that. All right, so one last question here from Anthony. He says, if a stock has a bearish rating, but you scroll down, it says strong buy. Which way should I go, buy or sell? All right, so I assume when he says bearish rating, he's looking at our stock sentiment score, which runs from bullish to bearish. So let's go somewhere where we actually have one. Boy, I'm not good at typing today. There we go. All right, so what this does is it looks at the last 5 days of trading to try to determine how the market feels about the stock. Okay, so how it's performed over the last 5 days and what's likely to happen in the very near future is what this guy does. Okay, this down here, average analyst recommendation, we get estimates from Wall Street, we average them together, and that's what this is. So these are going to be based on like a 12-month price target. This is based on what the stock is probably going to do in the next couple of days. So whether or not you should buy or sell is really a question of time horizon, right? If you're a short-term trader, you don't care what the stock price is in a year, right? If you're a long-term trader, you don't really care what the stock price is going to be in 2 or 3 days, right? I mean, maybe, if you see the stock sliding, you might want to wait until the sentiment starts to tick up a little bit so you can buy it sort of near a low. But other than that, if you're a long-term buy and hold investor, the sentiment's not really that valuable to you. If you're a short-term trader, the average analyst recommendation really isn't that valuable to you. Right? They're measuring 2 different things. They're 2 different groups of people with 2 different sets of ideas about how to make money in the stock market, and they can both work, right? One's not right and one's not wrong. They can both work, but they're trying to use them in conjunction with each other doesn't make a ton of sense because it's 2 different things. All right, so I'm a few minutes over time here. Thank you all for coming and staying this long. Thank you for subscribing to Investors Observer. This session is being recorded. We'll send out that video tomorrow. Thank you all for coming. Our next workshop will be in 3 weeks, which is about April the 21st. So until then, you can hit this help button here on the website if you have any questions or give us a call. Thank you for coming, and I will talk to you later.